Senator Hagerty from Tennessee is recognized.
Thank you, Mr. Chairman. If you would allow me just a moment to speak to the tragedy that occurred at the Covenant School in Nashville, Tennessee yesterday. A depraved person, a sick person, executed a tragic act and yielded a terrible result. And my entire community is mourning. We're mourning for the families, for the victims, for everybody concerned. I also want to acknowledge the bravery of the Nashville Police Department. They stepped into harm's way and within 14 minutes brought the situation under control. Tremendous bravery at a time when it's called for, and I want to acknowledge their sacrifices. Now let's turn to the matter at hand. And I know that politics in Washington always seizes upon any crisis as an opportunity to achieve whatever regulatory or legislative opportunity or goal that may be in front of them. But I'd like to talk about managerial execution here. Specifically, I'd like to start with you, Chairman Gruenberg. I'd like to talk through a series of events that followed SVB's failure 2 weeks ago. As you know, Silicon Valley Bank was taken into receivership on a Friday morning. That gave the FDIC 3 days to find a buyer before markets opened on Sunday night. You had tremendous resources at your disposal. 18 years of experience on the FDIC board yourself. Detailed resolution plans. Over 5,000 employees and interest from a number of banks to bid, including at least one formal offer, as I understand it. Instead of successfully executing this process, however, the FDIC used the systemic risk exemption to guarantee all deposits at SVB, creating tremendous uncertainty across our economy. And now, 2 weeks later, the FDIC has announced the sale of less than half the failed bank's assets at a loss of $16.5 billion. So my first question, in the joint statement released on March 12th, you said, quote, no losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. Is that still your position?
Senator, yes, as you know.
Well, the problem is, with 2 partial sales completed and over $22 billion in losses already accrued, that position just doesn't square with reality. These losses are borne by the Deposit Insurance Fund. That fund is going to be replenished by banks across the nation that had nothing to do with the mismanagement at Silicon Valley Bank or the failure of supervision here. In fact, that's going to be addressed by a special assessment to those banks. And as we all know, these banks will have to pass these costs along. Last time I checked, those costs get passed along to the consumer. Those consumers are American taxpayers. Chairman Gruenberg, invoking the systemic risk exemption is a last resort emergency option to the typical methods of resolution, and it begs the question of why you had to invoke that extraordinary exception. Just this past Sunday's announcement of a new purchaser, part of SVB, not only were serious losses incurred, but the FDIC entered into a loss-sharing agreement with the acquiring bank, and a $70 billion line of credit was extended to the purchaser. That's a pretty sweet deal. And this makes me wonder what prevented the FDIC from coming to a deal like this 2 weeks prior. You told Ranking Member Scott that you received bids for SVB over the weekend following its collapse, but that they were insufficient. What was your counteroffer? And did you engage with the board of the bank that didn't approve this to get them to step up and approve it?
We received one offer that was frankly more expensive than the cost of liquidation. Didn't appear to be a viable offer at that moment.
Was there a counteroffer to that?
I would have to check with our staff in terms of how much of a back and forth occurred.
Let's talk about the bidding process itself. Were certain banks dissuaded by you or anyone else associated with this from bidding on SVB, either before or after the bank was taken into receivership?
No, Senator.
Throughout the course of that weekend, I was inundated with phone calls telling me that legitimate bidders were being waved off of the process. It's one thing to reject a bid if it's bad, but if ideology had anything to do with this entire committee is going to be deeply concerned about that. I look forward to the GAO's report on this because the result of this failure places the banking sector in a state of disarray that we've never seen before. In spite of all the preparation and tools at your disposal, the FDIC failed to do its job. There was obviously enough demand to orchestrate a sale. What it looks like to the American people is that you simply didn't feel the incentive to execute and leaned on the systemic risk exemption to buy time, and in doing so, have placed the entire U.S. banking sector into uncharted waters. I don't see any apparent improvement in outcome, and this is a disgrace. I look forward to the GAO review, and I hope that we get to the bottom of this. Vice Chair Barr, very quickly, I'd like to come to you. In response to the 2008 financial crisis, the size and scope of the regulatory regime was dramatically expanded by Congress. Regulators like yourselves are giving powers, not to mention hundreds of academics at your disposal, with the sole job of monitoring and addressing risk to the financial system. All of this was in hopes of identifying and preventing bank failures that pose systemic risk. And in spite of all these tools, we find ourselves in a situation today that is unprecedented. It's pretty clear that Silicon Valley Bank was woefully mismanaged. Their management team, which didn't have a chief risk officer for 8 months last year, yet created and maintained a chief diversity, equity, and inclusion officer, allowed their bank to accumulate truly shocking levels of risk. And while this was occurring, the San Francisco Fed was focused on researching left-wing policies that they had absolutely no expertise in, ignoring one of the most basic risks in banking, interest rate risks. Perhaps most damning of all, until the day of their failure, SVB CEO sat on the board of the San Francisco Fed. So, Mr. Barr, in your review of what went wrong in your supervision, will you consider the level of managerial distraction that was evident at the San Francisco Fed?
Senator, the staff have free rein to examine any issue that might have addressed supervision. I think the core issues are the ones I suggested at the outside, and they're really basic. Interest rate risk mismanagement by the bank, liquidity risk mismanagement by the bank. The San Francisco examiners, the examiners at the San Francisco Federal Reserve Bank called those issues out to the board, called them out to the bank, and those actions were not acted upon in a timely way. And so I think in a way the issue is pretty straightforward.
The sense of urgency that was brought to bear on this, and the sense of pressure, and if every tool at their disposal was used, because they certainly were doing other things well beyond their remit. Thank you. Thank you, Mr. Chairman.
Absolutely. Thank